Fannie Mae and Freddie Mac. You've probably heard these two names in the news a lot as of late. They are crucial to understanding the financial crisis of 2008-2009, and they have played a very important role in U.S. history. That's the goal of this video, to teach you some of the importance of these two organizations. So let's start with some history. Fannie Mae was originally founded in 1938 as part of President Roosevelt's New Deal program. The idea behind the New Deal was to jumpstart the economy by using a bunch of publicly funded programs. During the Depression, a lot of people had lost their homes. Banks were struggling, and they didn't want to make loans. So Fannie Mae was created to purchase and guarantee the mortgages to low-income families. This would create a market for the mortgages. People would feel a little more secure if the government was backing it up, and it would encourage banks to start lending again. Fannie Mae was originally a government agency, but in 1968, the government converted it into an organization called a government-sponsored enterprise. A government-sponsored enterprise, or GSE for short, is a hybrid between a government agency and a corporation. The debt is guaranteed by the U.S. government, kind of like a government agency, but it has private shareholders, just like a corporation. In 1970, the government created the Federal Home Loan Mortgage Corporation, or Freddie Mac, to compete with Fannie Mae. They didn't want Fannie Mae to be this monopoly. So Freddie Mac, just like Fannie Mae, was a government-sponsored enterprise, and investors could buy and sell shares, and the debt was guaranteed by the U.S. government. As I mentioned earlier, the major business of these organizations was to purchase and guarantee home loans. But there were some checks and balances involved here. Both Fannie Mae and Freddie Mac would only purchase and guarantee home loans that met certain minimum credit requirements. So if a bank issued a loan that didn't meet these minimum requirements, they would have to find other buyers. And this helped reduce the number of high-risk loans in the economy. So this was a pretty good checks and balances system for a while. But around the early 2000s, things started changing. The economy was booming, and the government wanted to encourage low-income families to purchase more homes. These low-income families were generally considered high-risk borrowers, and they often didn't meet the minimum credit requirements. So the government put pressure on Fannie Mae and Freddie Mac to loosen their standards. So in 2004, the government passed a bunch of financial incentives to encourage these high-risk, affordable loans. So banks would get certain kickbacks if they issued these loans. And this gave banks a very strong incentive to take on a little bit more risk. Now, at the time, this was well-intentioned. The government wanted to help underprivileged people. But unfortunately, it had some very, very bad consequences. It encouraged banks to take on excessive risk. And over the next few years, Fannie Mae became another speculative pawn in the mad housing frenzy that ensued. So the result of this, in 2008, the government had to take over Fannie Mae and Freddie Mac because they had guaranteed a lot of really, really crappy loans, loans that would be very difficult to pay back over any period of time. And so the organizations were effectively insolvent, shareholders were wiped out, and the government has nationalized them. So this is kind of the sad downfall of these two organizations, but they have played a very important role in U.S. history, and I hope this video has helped you understand how they fit into the credit crisis as well. Thank you very much for watching. For similar videos, I recommend you check out my website, www.canjo.com.